Hey everyone, it's KaTiya, licensed real estate professional here for Finance Fridays. Thanks for tuning in. I will be bringing up Pedro from First Centennial. Let's see, Pedro, where are you? I need you to turn your camera on. All right. So for Finance Fridays, we talk about. Let me see. Mute. There we go. All right, cool. So I'm trying to see where Pedro is. I can hear you clicking.
Yeah, I'm here. Is the camera
I
working?
can hear your voice.
I gave access to the camera.
Oh, okay. We're gonna figure this out. On the laptop right now.
Yes, yes.
Okay. Okay, it's fine. We gonna kind of make it like podcast style.
All
Hey
right, sounds
everyone.
great. Yeah, it says right here that my camera is active and is access.
Oh, maybe is it me? Let's see. Do you see yourself?
I do not. I mean, it says it's access, given access, but no, I don't see myself there either.
It's all good. They seen your pretty face on the promo. It's all good. We'll be all right. We just gonna I'll probably convert this to audio as well, so it's no problem. So we're streaming on YouTube, LinkedIn, and Facebook right now. And I want you to tell everyone a little bit about yourself, who you are, where you work, things like that.
Yes, yes. So obviously, my name is Pedro Janelle, loan officer, First Centennial Mortgage. I've been with First Centennial for 7.5 years now. Been with the industry for about 18, 19 years now, going on 20 as well. My background besides mortgage lending is in overall personal finance, business finance, investments, private client advisors, insurance. Obviously, these are all factors that go into the home buying process, well, besides the mortgage as well. So it's always a lot more information in the actual job role entails. That's where my background comes in there. Fluent in English and Spanish, so able to help with a lot of Spanish speaking clients as well. And that's pretty much my resume in a nutshell.
Yes, yes. I always tell everyone that I enjoy working with Pedro because Pedro gets the job done. I'm always appreciative every time we do a deal together. I'm letting you know that on live to the public right now because I greatly appreciate your service. So not just to me, to my clients, you're very communicative, reliable, and responsive, and that is very that's very amazing because you could hear the crazy stories about other people, and I'm not here to do that, but I do want to say that I enjoy working with you a lot, and that's why I'm so happy to have you today.
No, I appreciate that as well. And it's a team effort too, because it wouldn't work without you being on the same level as well.
Yes, thank you. All right, so we're gonna hop right in. I got some questions to ask you. This is Finance Fridays with KaTiya and Pedro. We got Berkshire and First Centennial here. I just want to let everyone know again that's jumping in late. So we're gonna hop right on to the questions. For the first question I have, what are some down payment requirements that you want to communicate to our viewers today?
Yeah, so they slightly vary depending on the loan programs you're qualifying for or the loan programs available. So the typical two biggest main loan programs that almost every buyer is approving with or qualifying for is conventional versus FHA. So we'll start with conventional. For conventional loans, for first-time home buyers, you can do as little as a 3% down payment. Typically, the minimum requirement for a conventional is a 5% down payment. Now, that applies to single-family homes, condominiums, townhomes, basically single-family unit type properties, which is the most obvious, most common properties purchased by first-time home buyers or just home buyers in general. The down payment requirements shift a little bit when we're talking about multi-unit properties, especially in the city of Chicago. That's very popular to purchase multi-unit properties. Here's where the differences come in on a conventional loan. Conventional loan, if you're buying a two-unit property, then the down payment requirement goes up to 15% minimum. If you're buying a 3 to 4 unit property, even if you are occupying as your primary home and renting out the other units, 3 to 4 units require 20 to 25% down. So with that, those higher down payment requirements, here's where the transition into the FHA loan program is. So FHA, the FH doesn't stand for first time home buyer, which I get a lot frequently. It's That's for Federal Housing Administration. So it's a government insured loan from the Department of HUD. Because
Okay,
again,
thank you. Thank you for that.
yes, yes. So, and it's actually not geared towards first-time home buyers. It's not specific to first-time home buyers. It's actually more towards those that need to take advantage of those benefits or those programs that may not be available on a conventional loan. That's really what it comes down to.
Okay,
Because it's insured by the Department of HUD, they there's certain uh, avenues that basically will be allowed because they take on half of the risk. So it's kind of like the money comes from First Centennial or any lender that you're applying with an FHA loan, but it's insured by the Department of HUD. So we
okay,
give the money, but because they help back it up at least for half of it, that's where the risk gets lower, where certain requirements could go through. In particular, the biggest common thing is the lower down payment option of 3.5%, 3.5% of the purchase price. And that could be from a single family, a condo, townhome, all the way to a 2, 3, or 4 unit property. So that's why the FHA loans are more popular for those that are looking to minimize their investment towards the purchase up front, especially for multi-unit properties. The other reasons people will go FHA loans versus conventional is, maybe because they have a lower credit score requirements. They let your income stretch further for the loan approval amount versus conventional, so it's not as strict as conventional on those aspects. So,
okay,
everybody's individual finances are like fingerprints. So really, it's kind of like an apples and oranges comparison on your finances. Many clients qualify for both, but the budgets will be different on your approval than we compare it to their goals as far as like what they're searching in their price range.
okay, okay. That was a lot. I appreciate you breaking all of those different things down because, yeah, it's very beneficial. All right, let's roll into the next one. So let's talk about the source of funds and closing costs for down payments.
Okay. Ideally, obviously, you want the funds to be coming from your own funds or a combination of your own funds and gift funds. Gift funds
Mhm.
meaning that funds you get from family members. Typically, it's family members, parents, relatives, significant others. It could be spouse or significant other. And everything has to be sourced through bank statements. So it cannot be cash under the mattress or recently large deposit that we can't verify the source of. It has to be all verified funds. And even the person giving the gift, even though not involved in the transaction, we still document the funds from their bank statements, per federal guidelines. So that's where the main source of the down payment and closing costs ideally could be from. There are down payment assistance programs, typically with the state of Illinois, Illinois Housing Development Authority, nicknamed IHDA. They offer a lot of programs that help assist with funds towards down payment and closing costs. Now, not to get it confused, it's not free money, it is not grants the way, unfortunately, is not accurately advertised in many places. They are second loans. They're recorded as
Okay.
second loans at the closing. So you do have a second lien. Now, some options you pay back with no interest, and some options they're forgiven if you meet certain terms.
Okay.
The most popular option that's available is there's a $6,000 option where you get $6,000 towards your down payment and closing costs. It's recorded as a second loan at the closing, but if you stay in the property for 10 years, do not sell, do not refinance, the $6,000 is completely forgiven, the lien's removed, and you never pay it back. They also, what they do is called prorated, meaning that if you don't exactly owe the full 6,000, if you don't meet the 10-year requirement, every month you're in the property, the amount you owe is less and less and less until it hits zero at 10-year mark. So, for example, if you sell the house in 5 years, they only have to pay back 3,000 because you met half the term. So
Okay.
they give you credit for the time that you're in, so you don't owe the full amount. Same concept. You refinance in 5 years, you owe 3,000 to closing. In both scenarios, it doesn't have to necessarily come out of pocket. If the value has increased enough where you could add the 3,000 to the refinance loan amount, you don't pay it out of pocket. In the sale aspect, it comes out the profits from your sale. So sometimes it's a win overall because the amount of equity you gain in 5 years could be well more than 6,000 or 3,000 that you pay. So you end up still winning in the long run if it's your long term plan to stay in the property for a long period of time. So your plans on what the property is really determine the benefit of the down payment assistance program or not. If someone's telling me it's more of a short term investment, they plan to fix it up and sell in a couple of years, may not be the best option because you may not get the equity compared to the upfront costs. And
Okay.
that's another example of customize it to the individual's application versus just saying, hey, here's some money that can help. We want to know your long-term plans to make sure this actually makes sense, because we don't want to come back in 2 years and find out that you owe a whole bunch of money back.
Right.
No
So
problem.
really quick, because I know there's instances where there's co-signers when it comes to source of funds and things like that. So if someone that just wants to co-sign, but they don't necessarily want to be a part of the transaction, how does that process work when it comes to source of funds? Do you still need to see what they have in their bank when they want to help a person buy something, or is it just like kind of credit based?
So there's really no in between. You're either involved with the purchase or not. So if you're a
Okay.
co-borrower on a mortgage, you're equally liable on the credit. You're equally liable on the loan, 50-50. You're equally owner on the title, because if you're on the loan, you have to be on the title as well for the property. So you're purchasing it with that person.
Okay.
Now the question is the funds part. The funds part is where it could be yes or no. Just because you're co-signing on someone's mortgage and you're purchasing it with them doesn't mean you're necessarily putting up the money yourself. If the 100% of the money is coming from the main buyer, and the person's really helping credit and income wise to help with the qualification because they're limited on their own qualifications themselves, the money could come from one, the other, or a combination of both. It's not considered a gift, because if they're involved in the transaction, they're actually buying it. It's their investment too. And
Okay.
then, so whatever money they do help with is actually them contributing their own funds towards the purchase, not considered a gift. It's a gift when they're gifting the money to help somebody else with the purchase, and they're not involved in the transaction at all. That's what the term gift actually applies to. It's not a loan. The reason this document is a gift is just so, like, if that person decides to change your mind, saying I want my money back, they legally can't sue and get the money back, because you signed that it's a gift and they don't have to pay it back.
Oh, okay.
That's why it's documented as a gift for the loan purpose, because that avoids the potential of someone suing you, putting a lien on the property in the future in case there's a kind of a misunderstanding of, the source of the funds.
Okay. Um, I wanna, I have a couple more questions, but I do kind of want to ask. Let's just go through the questions, and then we could kind of like I can kind of pick your brain a little bit too.
Sure.
So the next one is because you kind of mentioned like the down payment stuff, the down payment programs and assistance. Um, what are some first time home buyer programs um that are available that match with the financing? Because I know you mentioned like second mortgage and things like that. What would these things be called? Is like I guess I have a couple of questions. So that part, in addition to I went online and I did a little bit of research. Do you recommend individuals do the Fannie Mae home buying course? It's a free Fannie Mae home buying course. I believe it's a certificate. It's like 7 or 8 steps. Would you advise someone to do that first prior to applying for a mortgage on their own? And then, kind of, what will be the programs that they're looking for? The name of those first time home buyer programs.
Yes, definitely. I mean, it's just a great educational source, and the fact that it's free, it's just a matter of taking the time to go through it. It actually explains a lot of the information that I end up explaining during the pre-approval process as well when I take a new application and new client.
Okay.
And if we end up signing you up for any of these first-time homebuyer programs, when under contract and underwriting, it's actually a requirement to take this course. We actually send the link to take this course per underwriting requirements
Okay.
if it wasn't done beforehand.
Okay.
So, I mean, it's great that it's done beforehand, but if we end up signing you up for these programs, you will be taking this course at one point when you're on the contract. At least you have this information before you actually close on the purchase. So the first-time homebuyer programs, the biggest misconception is people think down payment assistance programs and first-time home buyers are the exact same thing. They're not. Because the
Okay.
down payment assistance programs I just described, you don't have to be a first-time home buyer to qualify or apply for them. You could be an existing homeowner and buying a new primary home and still apply for those programs if you're looking for additional funds.
I want to jump in with that statement. So, if they are a previous homeowner, is there like a time frame gap of when they are able to do something like that, or is no limitations? So, if I'm a homeowner and I bought a house last January 2022 and I want to buy something else, um, I didn't get anything the last time. This time I'm interested in getting something else, and I might want to turn this property that I bought in January into an investment property and the next one to my primary residency. Is there a time frame to do something like that, or what's the stipulations?
Not for the down payment assistance programs. So
Okay.
Without, if you look for the program I described, like the $6,000, I gave an example program, that's not specific to first time home buyers. It's
Okay.
as
Okay.
long as the property you're purchasing with that program is going to be your primary resident,
Okay.
then you could qualify, obviously, if you meet all the terms and requirements on their end. Now, what doesn't apply to is the first time homebuyer programs. And here's where the difference is. The
Okay.
first time homebuyer programs, that's tied in with the Fannie Mae course you mentioned, is called Home Ready. And then Freddie Mac has their own similar version called Home Possible. They're both pretty much similar. The only reason one will go Fannie versus Freddie if there's like specific guidelines in the qualification where like one will be more favorable than the other, or but majority of the cases, if I can see one has a better interest rate, that's the program I'm going to be offering. So that allows you to do a 3% down payment, but it also, if you meet the income and credit requirements, it also gives you a discount on the interest rate and a discount on the PMI, the private mortgage insurance, which I'm sure people have questions on. We can describe later.
Yeah.
So it basically saves you money on your payment. Now, it does have a household income limit on the application. So it's actually geared to help lower and minimize the payment for people under a certain income threshold. In Cook County, where most of our transactions are, that income limit is, I'll get the exact number now, but it's about 84,000.
And that's for a single purchaser, not a couple.
It's for anyone on the loan application.
Oh, okay.
The thing
So
about this program,
combined household up
right,
to that number. Okay.
right. The good thing is that here's the difference between this program and the down payment assistance program. The down payment assistance program has their own separate income limits, but they count everybody moving into the property, whether or not they're on the loan.
Okay.
Home Ready, Home Possible only counts the income of who's applying for the loan.
Okay. Good to know. Because everyone moving in, that would be like if it's a student worker in the household, right? Then
Exactly.
okay.
They'll count that. They'll count that income. They ask for income documents on anybody moving in the house, but they
Mhm.
also count a higher income limit if there's two people versus three people versus four people too. There's different income limits based on the number of household. Home
Okay.
Ready and Home Possible is very simple. They only count what we document for the purchase on the loan application.
Okay.
So the Home Ready exact limit is,
Dun, dun, dun.
all right, here we go.
And while you're looking at it, usually you can help determine these after someone submits an application for the pre-approval. You'll
Ex-
just
exactly, yes. And I'm
okay.
always looking to help people qualify for Home Ready and Home Possible just because it would just help them save, especially with the rates being the way they are now and being
Okay.
so competitive. Obviously any opportunity to lower it, we're looking into it. So
Okay.
actually, they just raised it, so it's $87,520 annual income limit. So
Okay.
that amount and under is the income limit to qualify for this program.
Okay. And oh man, I had a good question. I lost my thought. Um okay, so with these programs, what would be like conventional, a lot of people don't know that conventional is 5%. They always assume I always get that where they assume it's 20%. So I tell them it's around 5%, but it's really based off of what you're looking for. So with these other programs, these first time, right? The home ready, right? What
Right.
would what would that down payment percentage look like just for those two programs that you
You could
mentioned?
do as little as a 3% down payment if you're a
Okay.
first-time home buyer. Now, first-time home buyer, the definition of a first-time home buyer is someone that currently does not own a property
Okay.
and has not owned a property in the last 3 calendar years, meaning like the last three tax years. So we're in 2023. You basically have not had to own a home in 2020, 2021, and 2022 and not have a property now in your name to qualify as a first-time home buyer.
Okay.
So you could have had a property owned like as late as 2019, sold it, whatever the case may be, where you're no longer the owner, and you
Okay.
just were a first-time home buyer this year.
Gotcha. Okay. Um, all right. And then because that those are the programs. Um, let's discuss because I know this is the one that this question I know everyone is always waiting for. How do you determine the credit requirements? Because I know they're probably not just score alone. Could you please let our viewers know what are the credit requirements for financing?
Well, the start with the scores. It is not a fixed score across the board because they look
Okay.
at the overall picture, the whole credit profile, and your overall financial profile. So I'll start with a
Okay.
conventional loan. The conventional home ready, home possible. And if you're doing 3% down, ideally you want your score to be 680 or higher, ideally.
Okay.
Because we take all three credit scores, we pull all three credit bureaus, and the number in the middle was used for the qualification. So if you have a 700, 680, and a 660, 680 is your qualifying score. Uh, with a conventional loan, 680 or higher will get you the most competitive market interest rate, and you will get you a fair pricing on the monthly mortgage insurance, or PMI. Because on the conventional loan, the two biggest factors that determine how much you pay monthly in your PMI is your credit score and your down payment amount. So you're already getting charged a higher PMI by doing the 3% down payment, but it's also scaled back and minimized if you have a score of 680 or higher, or even better, 720 or higher gets even better deal.
Okay.
Um, Now, can you qualify for a conventional loan 3% down at 660? Yes, it really determines not just the score itself, but it really depends on your overall credit profile. It's not just what the score is, but the reason the score is there. So if your score is 660, what's the reason the score is 660? Did you have late payments? Do you have collections?
Okay.
That could be a situation where if you're doing 3% down at 660, you may not get approved. Now, if you have a 660, but the only reason you're at a 660 is because you just have high balance credit cards, but no late payments, no collections, then you may get approved because it shows that you still have a clean credit history, but your score is because more your credit card balances could be over like a certain percentage of the limits, which causes a decrease in your score.
Okay.
And but I I end up still gearing them towards the FHA loan because the interest rate and the PMI will get very expensive if you're under 680, even if you could get an approval. So there are
Okay.
situations where they may like a property where they're saying it's conventional only, and
Mm,
our buyer qualifies for conventional, but it's like a two, three, $400 increase in their payment compared to the FHA loan because of the credit score and still doing 3% down payment. So that's a scenario where, like, hey, we could get you in the door. You qualify. We get the offer accepted. We get you to the closing table, but you're not necessarily in the best financial situation. But it may not be the only one to get accepted in that particular scenario. So that's how some people could be. So that's a gray area where, like, we recommend the best financial options, but it may not line up towards the property you're looking for.
yeah. Yeah. Okay. So that's really good because so basically 680 you have that financial cushion on the payment. That's
Right.
really good to know. I thought it was less than that, honestly. So I thank you.
No, no.
Okay. Okay. Sorry.
And real quick, I've have gotten deals approved where we got as low as a 610 or 620 and gotten the
Okay.
conventional approved. But in those scenarios, they were compensating with like very large down payments, like 30, 40, 50% down payments. So you got to remember, like, is the overall picture is credit, income, liabilities, and investment. How much of a loan versus value, which is your down payment, is a difference. So if someone's putting a 50% down payment, they will have a better chance of getting approved. Their credit scores in the lower 600s because they won't get the best interest rate. The interest rate still be expensive, but they'll still get an approval because they still have so much equity where it's still considered a lower risk.
Okay. So, oh, really quick. So, what would that look like? Let's say, like me, I'm self-employed. I have no credit. I'm just gonna. This is an example because I do have credit. But let's say I'm self-employed, don't have any credit. My credit score is coming up. Let's say I have a car note. My
Mhm.
credit score is coming up at 640. No other lines of credit. But I have 15% down and I want to buy a house. For someone that's self-employed, how would that look?
I've in that exact scenario and similar scenarios, I've actually had gotten approval for a conventional loan approval at 50% down.
Okay.
Or 20% down or more. Something it was case by case scenario, but it's possible.
And
The
what would
interest the
oh,
interest
sorry.
rate. Sorry, go ahead.
No, go ahead, finish.
I was going to say, like, the interest rate may not be the best. You
Okay.
will save on a PMI because your PMI, even though it's could be higher because of the credit score, is also lower because you're doing a significantly larger down payment. Because the higher the down payment, closer to 20%, the lower your PMI as well. So
Okay.
that helps you save as well. So that's a scenario where, like, it's definitely doable. Now, it's still based on analyzing your credit profile. Like I said earlier, the reason is at 640.
Okay.
So and then sometimes we may not get an approval at all, regardless of how much of a down payment, because it's just a lot of late payments, recent collections. Sometimes the timing of what cost of scores is an issue too. Like, are you 640, but then the negative items on your credit report are more than a year or two old, or
Mhm.
are they really recent in the last few months? That's a huge factor as well.
Gotcha. Okay. And then two questions. What so for someone that doesn't have any credit, would you advise them to open up a line of credit, like a credit card or something, just to help boost their score up?
Yes, definitely. I mean, well, the really definition of no credit means that you have zero credit history. It means like if I pull a report, it's just a
Okay.
blank report with no scores. If you have negative credit history you're trying to build back up from, yes, definitely. They want to see like a new account with a fresh payment history.
Okay.
Um, and then, but paying off what you owe from what caused a negative credit is also an additional factor as well. They all kind of work together. So to simplify how your credit score is analyzed and looked at and how they even calculate the scores is really three main factors: is how long of a history you have with your credit lines, how long
Mhm.
of a positive history,
Mhm.
your on-time payment history over the last 24 months.
Mhm.
And then the third category is the utilization of your credit cards, how many balances you keep percentage wise versus the limits. So ideally, you want to have your balances on your credit reports, at least the balances reported to the credit bureaus every month from your credit cards, under 30% of the limits. So if your limit's $1,000, you don't want to maintain a balance reported for more than $300, for example.
Okay.
So I see a lot of scores of the credit reports where like they have perfect on-time payment history, had long history with credit lines with no issues whatsoever, no collections, and their scores are still in the low 600s because their credit cards are always maxed. But a
Mm.
lot of times, it's not because they're in a huge amount of debt. Sometimes these credit card limits they have are like $500 card limits, 300 credit card limits. So the second you do one purchase, it's hitting your score because the limit's so low. That same credit card balance with like a $5,000 to $10,000 limit will boost your score up, and you really didn't acquire any more debt. Because you could also apply with your credit card company, and that's for a new card. You could apply for them to increase the limit on your existing card. They have to do another credit pull to do that.
Okay.
If they increase the limit and you have the same exact balance, when that reports to the credit bureaus, you'll see a boost in your score just on that alone without taking on any new debt or any new lines or any more spending.
Okay. So, all right. And then can you tell everyone what PMI is, and then we'll wrap this up with our final question. What is PMI?
So PMI stands for private mortgage insurance. So a little history, long obviously decades ago, no one bought a house for less than 20% down. But it was a lot easier when homes were like $50,000. So as homes got more expensive and income and people's savings weren't catching up with the price of homes, instead of saying, hey, you can buy a house for 20% down, now you could buy a house for as little as 3% down or 3.5% or 5% down. But it's considered a risk when your loan amount is very close to the value, especially at the time of the purchase.
Okay.
So instead of saying you can't do it, private mortgage insurance is an insurance policy that protects the bank on the loan in case you are late on your payments or defaults on the loan and don't pay it back. So it protects the loan because it's already a high risk and it's added to your monthly payment and paid for by the buyer or the borrower, whoever's taking out the loan.
Gotcha.
And so that's the purpose of it, is really to protect the loan itself for it being less than 20% down payment, which is considered a higher risk. But that's why the dollar amount you get charged is lower if your down payment is say higher but not 20 exactly. So it's like increments. You get a discount on the PMI and the prime mortgage insurance if you do 5% down. Then you get another discount if you do 10% down, another discount if you get 50% down. Then it's completely eliminated or not required if you do 20% down. So that's PMI. Now this only applies to a conventional loan. The misconception is that PMI does not apply to FHA loans. They have a completely separate system.
Okay.
It's not
Thanks.
called with FHA. It's not called PMI. It's called MIP, Mortgage Insurance Premium.
Okay. Cousins, PMI and MIP.
Exactly, you can call it cousins. Yeah. Um,
Got you.
FHA is very, very simple. So because it's issued by the Department of HUD, they insure the loan. Here's the mortgage insurance part that they insure as well. So they charge a flat amount based on the loan amount, regardless of credit score. As long as you qualify for the FHA loan, you're getting paid to charge a flat percentage of the loan amount in your monthly payment. Now, if you do less than a 10% down payment, that PMI stays for the whole life of the loan. You can never get rid of it as long as you stay in the same loan. If you do 10% or more down payment, it's for the first 11 years of payments. There's no way to avoid MIP on an FHA loan. Even if on an FHA loan you did more than a 20% down payment, even if you did a 50, 70% down payment, and it took
Okay.
out like 20, 30%. If it's an FHA loan, you'll have MIP in your payment. It will just be dropped off in 11 years if it's 10% or more. That's the main difference there.
So is it a way to pay like, let's say they want to pay the MIP off before the 11 years. Is that a way to do that?
For conventional and FHA, they have the similar way. So real
Okay.
quick, going back to conventional, like if you do have PMI and conventional, it drops off once you hit 22% equity. Like there's a schedule of your
Okay.
payments. There's a difference
Okay.
between the value at or purchase price at the time you purchase to 22% of the loan amount difference.
Mm.
You hit your
Okay.
payment schedule. So the only way on both FHA or conventional to get out of it, while still being the same loan, is you can't pay off the PMI or MIP up front. You could pay down your principal balance to the balance where the schedule is set for it to be removed. So
All right.
when you close on your loan, you get an amortization schedule, 30-year mortgage, you get your payment schedule, and it will say to the exact penny what the balance has to be for it to drop off.
Okay. Thank you. All right. Final question. Um, we've talked about credit, right? So when we talk about credit, you kind of broke it down a little bit. So I had the question, but the PMI and the MIP got me. Um, with credit scores, I guess is it so one of them is 580 scores. Is that still a thing when purchasing a property? Do you have to put down more? Are you maxed out on interest? I'll stop here and then I'll have the other question after you answer because I know it's coming.
So if your score is between 580 and 619,
Okay.
automatically you're an FHA loan only. Conventional is not.
Okay.
And is really a case by case scenario. Now, when you're under 620 for FHA ideally you want to be 620 or higher to get like a straightforward fair deal. Between 580 and 619, you could qualify with 3.5% down still, or you may have to put in a higher down payment if you're trying to compensate for other factors. Is really like it goes back to what I said earlier, is really the reason why the score is in that range.
Mm-hmm.
Um, I successfully got people approved at a 580 score with 3.5% down payment, straight purchase FHA, because the reason they were 580 wasn't exactly like severe negative items, more like
Mm-hmm.
high debt. It could have been a couple of late payments, but they're more than 12 to 24 months old. So they just basically haven't bounced back yet score wise, but the negative items are like, in the past, long enough in the past where it's not the concern anymore. And, it's more they just have to pay off certain debts. And in other scenarios, sometimes they're 580 because they have like so many credit late payments. And if, regardless of how much of a down payment, they may not get approved because the credit profile itself is considered too high of a risk, even though they meet the score requirement. So that's where it's really on. They're analyzed based on a case by case scenario. Now, with those scores, real quick, there's this thing called, everything I discussed so far is considered automated approvals when we run your profile and application through our system. Now, when we fall in these categories, sometimes when you're in the 580 to 619 range score wise, you may fall what's called manual underwriting, where you're not getting an automated approval with the system. Now, a live underwriter has to actually review your credit profile and details to see if you meet FHA's manual underwriting guidelines. It's a long list, but a couple of items I could tell you up front that's very common is the you can, if manual underwriting is the only option, you cannot have any credit card late payments in the last 12 months, and you cannot have any installment loan payments, which are most commonly auto loans, for example, in the last 24 months. If you
Mm-hmm.
have a late payment in any of those categories in those time frames, you're automatically disqualified for manual underwriting. Now your only option is to try to get credit improvement to get you into like 620 range or higher to qualify for automated underwriting with FHA.
Okay.
So that's really like anytime I get an application was in that range and I'm looking at the information, I say there's a possibility this could work. I have to send it to my underwriting department and they have to pretty much review the application and credit profile up front to see if it meets like the long list of guidelines for manual underwriting. And
Okay.
part of the pre-approval phase up front to determine, hey, would they qualify, would they not, what would be compensating factors. A lot of times you may have to show that you have additional savings to back up the down payment. Like besides the down payment and closing costs, you may have to show you have 3 months of the payment in savings called reserves to back up the payment, just like emergency savings. You may have to increase your down payment to like 5 or 10% to qualify. You may have to pay off some debts or show more income or get a co-borrower. It could be any of those things or a combination of any of those items. It really comes down to the individual scenarios. Is it possible? Yes. It's a lot more legwork. Yes. My recommendation is the best thing to do is always try to improve the score first, because
Okay.
even if we could get you approved, you're not going to like the interest rates in those credit scores.
Yeah, that's what my second question was about, the interest rate difference. Like, so it's like I'm here to tell everyone it's always better to have a higher score, yes, so that you have a better opportunity at better interest rate so that you are not what is it, house poor? So you're not house poor
Yes.
trying to buy a home.
It also increases your purchase power because the lower your
Yeah.
monthly payment is, the more your purchase power stretches on compared to the same income too. That's the other factor. Because sometimes, let's say we could get you qualified at 580, but it may not be the price range you're looking for. And sometimes just getting into 620 or higher will help reduce the interest rate and increase your purchase power with your same credentials. And it's not just saving the money up front. It really helps you get the most high, basically maximize your income to the highest price range possible.
Okay. Well, there we have it, ladies and gentlemen. I dropped your link in the chat for everyone that's been tuning in and for those that are watching the replay. Thank you so much, Pedro. I think that this was a powerful virtual Friday Finance Friday today. You've gave us more than enough information. I think everyone that's watching should be more knowledgeable and understanding the process. Everyone, feel free to reach out to Pedro directly at Pedro. Say your last name for me.
Pedro Henao.
Henao. There we go. I knew you was gonna say it. I knew you was gonna say it for me. Okay. PedroHenao.com. The link is there in the chat. Share this with your friends. Like it, subscribe to the channel, like the page, whatever platform you're watching it on. Get in contact with Pedro. If you've watched this video, put my name in the agent reference box so that he knows that you watched this. I greatly appreciate you, Pedro. And until the next Finance Fridays, Pedro, will you be on with us next month? Really
So
quick.
for next month, yes, I am.
Okay, cool. Go ahead. I'll let you say what you got to say.
I thought it was next week, but yes, it's once a month.
Yes, this one's. Unless you want to hop on next week, we could do another one next week. I just got Friday opened up while we were live. So if you want to come back next week, that's fine with me.
I'm open. Let me know.
All right, let's do it. All right, everybody. Talk to you soon. Have a good one. It's KaTiya Magee and Pedro. Bye.
Bye.